started.
Hi everyone. My name is Syed Kunain Ali and student ID 61974. Today we are offering our portfolio management analysis in terms of risk evaluation and strategic investment ideas. We discussed in our presentation how we have built a diversified investment portfolio following the principles of modern portfolio theory, determined its risk profile and formulated full mitigation strategies. Introduction. Uh, Next slide. The main aim of our portfolio is to achieve maximum returns and adequately manage risk through good portfolio diversification. Foundation, we have based our process on modern portfolio theory that shows combining different risk return assets could help investor realize optimal expected returns. Diversification is all about lessening unsystematic risk through having spreads of investment in different assets classes. Third slide, portfolio construction and justification. There are five distinctive asset classes that we choose so that we carried out an optimal risk to the asset ratio. The first is Apple Inc. Apple Inc. equities have a high degree of growth potential, but are more volatile. With the fixed income such as Vanguard Total Bond Mark ETF, and there are consistent streams of income. We added the commodities through the SPDR Gold Shares ETF, which appears to be a reasonably efficient inflation induced hedge. The SPDR NP 500 ETF Trust cost a wide market spectrum and cash equivalents via the iShares Treasury bond. ETF will secure maximum liquidity to take care of short-term commitments. Slide number 4, portfolio construction and justification. I would like to describe the risk return profile behind each type of assets. The expected growth and volatility of equities are 8% PP, expected returns, and 15% standard deviation. Bonds perform at 3% of return and have just 5% standard deviation. The returns of commodities are 5% with standard deviation of 10%. The S&P 500 ETF provide returns of 7% with the standard deviation of 2% using low volatility. The direct inverse relationship between equities and bond reduces the overall risk of the portfolio. When stocks fall, bond tend to do superbly and offer beneficial portfolio insurance. Thank you. My next member will continue the presentation from.
Thank you, Conan. So I'm going to discuss investment process in slide 5. We have a systemic three stages process of investment. First, asset selection involves identification of possible investment in various asset classes. So second, we use fundamental audit to come up with in strict value by looking through financial reports, macroeconomics and industry factor sales. So third, we complement this using technical analysis where we look at the past price patterns and then the amount of trading that occurred in order to predict the future price fulfills. So there is a combination that guarantees extensive measurement of investment opportunities. So when we move to the slide 6, whenever the performing valuation, we apply various methods. So price to earning ratio is used to determine the valuation of equities in relation with the earnings. Discontinued cash flow analysis is the analysis of estimation of present value of future cash flows as well. So market value comparables are an evaluation of measures of comparable firms. In the case of performance measurement, we can use the Sharpe ratio to determine the risk-adjusted returns and determine how our portfolio performs with other market in indications. So when we move on to the next slide, in this slide, I'll be discussing portfolio management and risk analysis. So our portfolio management plan would be in a balanced from based on moderate growth and reduction of risk exposure factor. We have singled out a number of vital risk factors, invigilating by the ups and downs in the economy alongside geopolitical occurrences, which in termed as market risks. And so this can greatly influence overall performance. So when it comes to price, in interest rate risk has an impact on the price of assets, especially bonds. So the inflation risk decreases the purchase power and may wipe out the real returns. So the liquidity risk is associated with the ease at which we engage in the selling of purchasing goods without any effects on the price of assets. So when we move on to the slide 8, I'll be discussing portfolio risk as well. So portfolio risk is measured using complex risk measures and managed. Return violating is represented in standard deviation. So beta is used to determine how the portfolio reacts to the market movement. Value at risk is calculated of is a calculation of a possible loss after a specified time at a particular level of confidence. Okay, so I'm gonna move on to the next slide. I'm gonna pass this presentation to Sabita. Thank you, Sabita.
Thank you, Right. I'm going to present about the risk mitigation strategy. There are the three types of risk mitigation strategy. The one is the systematic risk. Does not allow diversification against market-wide effects such as economic recessions, interest rate inflation, and another one is the unsystematic risk, which is going to the single assets in the industry. And third strategy is the hedging. Futures and options provide firms with an insurance against the price movement. Put option works to reduce losses. Next slide, please. Then mitigation strategy. Key strategy are the diversification, which is investment by invest type, industry, and location in order to be exposed to one source of risk. Mixed asset portfolio has greater ability to resist market shocks as well as reduces effects of bad events. And other one is the rebalancing. Is this the periodic selling of the industry and risks and fixed large target of allocation have to be made and maintain the portfolio as within the objective and risk retirement of the investor to handle long-term risks and other benefits in a maximum way. Next slide, please. Then the final slide is the conclusion and recommendation. In our presentation, we found the balanced portfolio stocks of bonds, commodities, and effects in line with MT. Diversification minimizes unsystematic risks and has efficient trade-off risk return. And recommendation of this report add application in terms of international equities or real estate as this allows greater diversification and eventually returns. And routine rebalancing as a reaction to the market situation and in accordance with financial goals, apply hedging rebalancing strategy to remain risk profile and set goals. Is this our conclusion and recommendation? And our final slides is the reference, which we include the industry articles, annual reports. All of this include in this presentation. Thank you, everyone.
Okay, I'm gonna stop the recording now. Thank you.